For years, we've heard people say that silver is undervalued compared to gold. It's the better buy. This assumes that you either buy and sell at very specific times or you get lucky at some point in the future. Your bet pays off. Now, if this is a bet that you've been making, it all of a sudden seems like maybe your odds just improved. So there are a lot of ways to buy gold. Just buying a little bit at a time, averaging your cost, that's probably the most practical. Don't overextend, don't ape in, hoping for some kind of moonshot. Pretty easy, and also probably the safest way to do it, but safe is a problem for some people. They want a strategy with a higher return if one exists. And this is one of the ways that the gold to silver ratio shows up. This idea that there is a back door or a way to add a multiplier to an otherwise safe gold buying strategy. We're going to get into that further, but before we do, quick shout out to Summit Metals. If you're looking for gold and silver, they've got you covered. If you're looking to sell your gold and silver, they can help you there too. SummitMetals.com. Now today, gold is about 80 times the price of silver, so the gold to silver ratio is 80. And some people out there say that's too high. Silver is the better buy, suggesting that buying silver is going to be a shortcut to get gold. That multiplier we were just talking about, a faster way to get ahead. Now, the way that this would work is you buy silver when the GSR is high, and then you wait for it to fall. Now, we were just looking at 99 in 1990, and it got down to 40 for a day in 2011. Now, spikes in either direction, they're pretty rare. There was a 21-year gap in those 2 points, but we see them now and then. There was a day in 2020 when it hit 114, and a few days in 2021 where it actually dropped to 65. The trend over the years has been higher GSR, with levels above 100 showing up more often, but only a single day below 75 since 2021. And you wouldn't say that movement was because silver became fundamentally stronger than gold. It was simply silver being more volatile. So this shortcut strategy would be to buy silver when the GSR is high and then trade it for gold when it's low. And I've mentioned this over the years. Lots of people imply that that's a good strategy. Some just come right out and say that it is, but there's a catch. Silver's higher premium makes that trade a lot more difficult than it sounds. The trade itself, that's not difficult. It's just coming out ahead that's difficult. Now, if the premium on this 1 ounce gold coin is 4%, and the premium on those 1 ounce silver coins behind it is 20%, you pay 16% more to get the silver, so the GSR has to fall 16% before you break even. So in practical terms, the GSR that's currently 80 would have to fall to 67 before that trade would make any sense. Can it be done? Sure, of course it can, but this is a waiting game. We haven't seen a GSR of 67 since 2021, when it bounced around that level for a few months. But again, that was due to volatility. If you bought silver the few weeks in April of 2025, though, when the GSR was 100, you would hypothetically be able to swap today for a profit. Hypothetically, because you'd still have to find a dealer out there who will forego the premium on the gold in a trade. And I'm sure they're out there, but I don't know any who will. So that's the game. Buy silver when it's the better deal, trade for gold when it's not. And because the silver rally kicked off after gold's, I'd say there's a real chance that we see the GSR fall over the next 12 months. There's no guarantee, of course, but this is the first time since maybe September of 2020 that I thought that there was a real case that it could happen. Now, the part of the strategy that just doesn't make sense, the strategy of buying silver to trade to gold, is buying an asset that's underperforming the asset that you actually want, and doing that for years in hopes that it will someday change. Now, we can see that silver has come a long way in the past 6 months, but gold has still been the better performer since fall of 2020. And that, of course, is before premiums, which would put silver at a big deficit. Now, I'm not saying that you have to go out and buy Canadian Maple Leafs. 15% delta that I've been using would be for similar retail type to keep the comparison fair. So 1 ounce silver Maple Leafs to 1 ounce gold Maple Leafs. Now, you can use whatever premium differential you like. If you're actually planning to trade, you're probably buying generic bars or something like that. Premiums are going to be less there, but then you would definitely be paying the premium on the gold that you're picking up. So why make this video now? Well, the likelihood of seeing a drop in the GSR, in my opinion, is higher than it's been in maybe 5 years. And if you're thinking about swapping silver to gold when the GSR is more favorable, well, my guess is that you're going to get that chance in the next 12 months. Now, the reason I see this happening in 2026 is that at some point, the continued run in gold price is going to slow down. And when it does, a lot of the investors making gains in gold are going to be looking for other ways to keep that run going. You've heard me mention before that the market cap of gold is roughly 10 times the market cap of silver. Gold ETF holdings about the same, 10 times silver ETFs. So if 10% of those gold holdings were to roll into silver, well, that would double the silver market, pushing prices up. So small drop in gold price, big jump in silver price. This would be a temporary swing, of course, but I think something like that will happen. It's only a matter of time. Now, just to be clear, I'm not saying we should all start buying silver instead of gold. There are some logistics here to consider. What most people will find is that they have to pay the premium twice. Once on the silver, once again on the gold. So you pay the premium on the silver in a purchase, you give that up in what's effectively a sale, and then you pay the premium on the gold that you're trading for. Air quotes on trading. Now, there are still ways that this could make sense. If you really want gold and the lower unit cost of silver makes it easier to accumulate, well, the mechanics work. You still end up with gold. But what most people don't factor in is that the premiums are going to make the timing that much more difficult. Premiums never seem to be part of the pitch, though. Typically, the GSR is just sold as buy silver at a GSR of 80 or higher and then trade it for gold at 40. Pretty simple. You end up with twice the gold you would have had. The problem with that theory, though, is that we've only seen a GSR of 40 once this century. Twice in the past 40 years. You really have to go all the way back to 1980 to make this kind of move seem normal. And that's really where this idea falls apart. What happened in 1980? Well, silver went parabolic. We all know that. It was driven by the Hunt brothers cornering global supply. Gold was spiking for its own reasons, and we're talking about a point here that's right at the peak of the biggest gold rally in history. And these two moves were not directly correlated. So a wildly fluctuating GSR wasn't a surprise. Repeating those conditions would be. Getting back to a practical case, I've bought silver over the years. I've converted it to gold when the math made sense, and there are definitely times when silver's volatility will work in your favor. I've had a few of those times in the 17 years that I've been buying gold and silver, but premiums are always working against that trade. Timing is never controllable, and future swings in your favor are always still a guess. I think where people go wrong is building a strategy around the gold to silver ratio, because any strategy that requires luck isn't really a strategy. It's more of a gamble. And let's call it good there. Let us know if you believe the chorus of people saying silver is the better buy. Something we've been hearing as long as I've been on YouTube, and something that's maybe been correct about 3% of the time. Well, if you hit the timing right, pull off a trade, you get to say this whole thing worked all along. It was correct 100% of the time, not 3. Just depends on how you frame it. Let us know what you think, though, in the comments. And then while you're there, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.